Welcome to another real estate industry update. I'm your host, Daniel Racanti, here with Kyle Paxton. We're with the real estate industry team here at James Moore and Company. And on our last episode, we talked about the One Big Beautiful Bill and all the great tax changes that came with it. But it also came with some negativity as well. And so we're going to go into a little bit more of that just because it's coming up quicker than a lot of people were expected. And so we want to get this episode out as quickly as possible. This whole episode is going to be about the green tax credits. This is something that has been talked about, boosted, a lot of extra benefits. And unfortunately, this bill came in there and kind of was like wiped them away, repealed most of them. Not instantly, but they are coming up quickly. And so we want to make sure that with the shorter deadlines that we're getting this episode out to you as quickly as possible.
Yeah, so to piggyback off of what Daniel said, I'm going to throw out something crazy. If you aren't familiar with these credits, it may already be too late to get started in some degree, but no, we're getting this out so we know that this is coming. The deadline's coming quick. So as Daniel alluded to, the green tax credits, One Big Beautiful Bill, really didn't change the structure of the credits. It just pulled back those timelines. So a lot of these credits had been extended under the Inflation Reduction Act and expanded to be more beneficial and pushed out to deadlines, 2032, thereabouts. The One Big Beautiful Bill had a lot of good stuff for real estate investors, but we got to pay for those really good stuff somehow. This is one of the areas where they pulled back on the provisions to help claw back some funds. So Daniel's going to take us through here some what we call big levers for real estate owners and things to look out for here over the next couple months.
Yeah, it's just weird because the Inflation Reduction Act of 22, when President Biden passed this, he really expanded a lot of green tax credits. Like that was his goal. And so pushing these out, like you said, another 10 years to 2032, also significantly increasing the benefits for a lot of these, just to have this bill basically come back and just claw it all back. And so these were something that a lot of real estate investors were, if they weren't already using, they were considering using just because of the extra benefit that we were getting. So let's kind of go into what were the main ones for real estate investors and just kind of give you a summary of what that is. So the first one is going to be the Section 45L tax credit. So this is the tax credit basically for more developers and home builders. Okay. So what it does is when a home builder builds a home, if they're building it and making it very energy efficient, they can get up to a $5,000 per unit credit. Okay. And this counts building single family homes or multifamily. Okay. They really expanded this. It was always a great credit, but $5,000 per unit, even for multifamily. Now, there was a lot stricter requirements. So the credit goes anywhere from 500 to 5,000 per unit. So you can see there's a pretty wide gap in there. And this is all about how energy efficient is. It basically, to get that 5,000, you got to make it a zero energy. I'm not exactly on.
The technical term of zero energy.
Yeah.
Yeah.
It's a zero energy ready home.
There it
Okay.
is. Yeah.
And by the Department of Energy. And so there was really high requirements, and you had to also have this thing called prevailing wages, which we're not going to go into in some detail, but it basically just meant that the people that were preparing the work were getting paid appropriately. You weren't paying for cheap labor, basically. All right. So they wanted to make sure that you were building energy efficient homes, and they wanted to make sure that you were paying people to do it. Even if you're not paying them directly, but the contractors that you use, they're paying their own employees the right amount. So you can see it can get really complicated here, but it was a great credit for these home builders that are going out there and building these multifamilies or these developments. And now it's like $5,000 per unit. And say you build 1,000 units, that's a pretty large tax credit. It's probably worth the hassle and everything that you can go to. This credit is only eligible for people with basis in the home. So basically what that base means is it's not the construction company. It's going to be the developer or the home builder that owns the home once it's been built. Okay. And then this credit is eligible once that home is sold to the buyer. So whoever is actually going to live there. That's when this credit is actually eligible. What happened here with the One Big Beautiful Bill, though, is they substantially pulled forward that deadline, and now it has to be 6/30/2026. Okay? So it basically, the home has to be acquired before that. So anything acquired after that's July 1st, 2026 or later is not eligible for the credit. So not only does the home have to be built, but it has to be sold to the buyer who's going to use it for their residence.
Yep, and leasing does actually count for acquired as well. I think it's important to add that in. And the beautiful thing about the One Big Beautiful Bill is that just about every one of these provisions come with a different effective date. So as we go here, we're throwing out dates. And if you watched our James Moore did a One Big Beautiful Bill webinar recently, and there's a different date for everything. So in summary, I mean, at a high level, get these done as soon as possible. And if you have projects in progress that are leveraging these credits, pay attention to those dates and make sure that you're hitting the thresholds in order to get the benefit. Because certainly the leveraging these credits have gone into the planning and the calculation of ROI and everything else.
Yeah, and I'm glad Kyle mentioned this. We did a real estate specific One Big Beautiful Bill video before this. Go back and watch that if you want a little bit more overview of it. But then James Moore did one bigger. It's not real estate specific, but just all over the whole bill. Of course, hosted by Kyle himself, so you know it's good.
Thank you.
So that will probably also go back and watch that as well. It'll probably be down there in the notes for you, a link in the notes. So let's go into probably the second credit. And it's not actually technically a credit, it's a deduction, but it's going to be your Section 179D. This is the energy efficient commercial building deduction. All right.
Daniel, I can cut you off there. I just want to demonstrate credit is usually a dollar for dollar reduction in tax, and then a deduction is more so it's reducing your taxable income that you applied the marginal tax rates to. Please.
Now, I'm glad you explained that because, that's something that we probably as CPAs just kind of gloss over, So tax credit is always better than a deduction, but a deduction is still better than nothing.
We'll take a deduction. All right. I'm not interrupting you. Carry on.
So how the Section 179D deduction worked is that when you're building cost energy efficient commercial properties, if you are making them again to a certain energy code, you are eligible for a deduction up to $5 per square feet. Okay. So it starts at 50 cents per square feet. So just like the 45L tax credit, there's a really huge gap here. Mm-hmm. But $5 per square feet is a huge deduction when you're building 40,000 square feet buildings. Okay. Again, this goes back to how energy efficient it is. Are you using prevailing wages? This applies, though, to basically the property that is used for lighting, HVAC, hot water systems, just the building envelope, anything that is going to be the energy part of the building, okay? And this one's a little bit different because for the 45L, you had to have basis in it, okay? This deduction was eligible for people that might not have basis for it, because it's either if you own the building, you're eligible for this, or if you are doing design, okay? So design for these specific energy systems for government or tax exempt buildings, okay? So where the owner is the government or the owner is a tax exempt organization, all right? This is where we see the deduction use a significant amount because in the other one, yes, you get a nice deduction, but it's your building. You're still going to get depreciation. That's, so you're getting it whether you wanted it or not. There's other things like cost segregations you can do. You can even combine them. There's a lot that you can do with it. But here, this is basically saying, hey, the owner of the building can't use the deduction, so we're going to give it to the for-profits that helped on this. So a lot of architects, a lot of engineers who are going out there and building these buildings for the government or for tax exempt entities. The most common one I see is schools. All right. We have a lot of clients that go out there and are building schools. And so schools nowadays have to be very energy efficient. Okay. The government requires it. And they want everything to be like, basically top notch, hands free, everything like that. And so if you are doing any kind of design to the energy systems, could be eligible for this. All right. So this was a great credit that got boosted with the Inflation Reduction Act. But unfortunately, this is also sunsetting same time as the 45L tax credit, which is 6/30/2026.
And
With
then,
different,
okay, I'm sorry, I was gonna jump in. I got too excited. The difference is it's the June 30th, 2026 for this is the deadline to begin construction. So you do have some more time here to leverage this deduction as opposed to the last credit we discussed. But that June 30th date still stands in this instance as well.
right. So it doesn't mean that you can't get the deduction after 6/30/2026. It just means construction needs to start by then. Okay. Now there's a bigger definition to that of like what counts construction. So if you are looking into this, you're gonna want to be working with your specialist here to look like, all right, is it starting construction to the definition of the IRS?
Call
Okay.
me and I'll show up to your site with my shovel and scoop some dirt, and we're in business.
Right. And so this one is one of those where it's like, hey, it's coming up fast. So it takes years to build usually large buildings of this size that you're going to do the 179D deduction for. So anything that is going to get built needs to get started here within the next year for you to be eligible for this. And then once it goes away. So unfortunately for the architects, the engineers out there who are reaping substantial tax benefits because of this is going away. And so you want to make sure that you're kind of looking into this as quickly as possible and then looking at your options afterwards. I'm going to also quickly go over the Section 48 energy credits, also known as the investment tax credits. There's a substantial amount of credits, and they did a lot of changes in this, so I'm just going to go very high level here. But basically, most of these are about renewable energy, solar, wind, things like that, okay? If you were installing solar panels on your business, you could get a 30% tax credit, things like that. Unfortunately, that is all being clawed back as well. The dates are all over the place for these kinds of things. But most of them are going to basically be either the June 30th, 2026, or it's going to be by 2027. Okay.
And this is
So
another one that functions as Daniel mentioned. So when you're talking solar panels, for instance, you could get up to a 30% credit on the cost of the solar panels, but that then reduced your depreciable basis if you own that asset or you own that asset. So it reduces the your cost basis by 30%. So then you get to depreciate less as a deduction. So as these credits go away, and we're going to get a little more into the planning components here, you're not fully losing the benefit of installing improvements like this, but it looks a little different, and it is generally a little less advantageous out of the gates there. But as Daniel said, the dates are all over the place on this one, so it requires digging in. And when you're looking at specific items, including if we're kind of venturing outside of real estate a little bit, clean vehicle credits and things like that.
yeah, so like the solar one, you have to have begin construction by July 4th, 2026. I basically gave you a year from when the One Big Beautiful Bill passed, and then it has to be placed in service by the end of 2027. So that's kind of how that one works. But a lot of these credits are all over the place. Just know by 2027, everything phases out. Okay. So there's certain deadlines for construction, and then there's deadlines for when it needs to be placed in service. And usually the tax credit is given when it's placed in service. So that's something to keep in mind as well, because a lot of these tax credits, you need to be acting now to get it a couple years from today. So what does this mean, Kyle?
What does this
So
mean? Finish your
all
project.
the real estate investors who are taking advantage of this, or were thinking about taking advantage of it, what are we doing now?
Well, at a high level, I've been clear if you've seen the videos. The One Big Beautiful Bill is great for real estate, and the big driver of that is the restoration of 100% bonus depreciation. So for the Tax Cuts and Jobs Act, of 2017, bonus depreciation was increased from 50 to 100% through 2022, and it's been scaling down 20% each year. As a refresher, what bonus depreciation does is it takes any assets that are eligible and allows you to deduct that, that percentage of the cost in the year in which it's placed in service. So what this means for these types of things, I already mentioned, for instance, for solar panels, with the removal of the credit, you still get to depreciate the cost of the asset. So what we're seeing back in a big way is my mantra I've been hitting is the value of doing a cost segregation if you acquire real estate. And so, you have, when you buy a parcel of commercial real estate, you have building and land. By default, buildings depreciable over 39 years, land's not depreciated. A cost segregation will allow a company to come in and bifurcate your 39-year cost recovery building into the individual components that are eligible for bonus depreciation. So there's still plenty of provisions in this new bill to push up the deductions. The caveat with bonus depreciation always is you're playing with time value of money. And so really what you're playing with here is, are you acquiring a property you're going to have a holding period long enough for to where you get that deduction in year one and you're not turning around and selling it next year to trigger a gain. So that is the biggest driver, I think, under the One Big Beautiful Bill of, making up some of these losses or credits that are going away, is making sure that your tax picture is optimized to utilize bonus depreciation and the expanded Section 179 on your asset acquisitions.
And Kyle's right here. I mean, there's still significant real estate benefits.
Yeah.
Okay. It's just changing how we get them.
Yeah.
In the past, it was really, they were trying to initiate energy tax credits. They're really promoting that you go out there and you make very energy efficient buildings. Okay. It came with a lot of restrictions. I actually had talking to clients how the zero energy home, it might not even be actually worth the tax credit.
It's a high threshold.
Yes, there's a high threshold. There's a lot going into it. So some of these they were trying to get people to build more energy efficient homes, but to meet the highest level was kind of, it was a ridiculous requirement sometimes. Okay. And then with the prevailing wages, it was a lot of work in that. Most homes built today do meet on the lower energy efficient one. So most people were getting the credit somewhere in the middle. That's just how it kind of works, right? Because it's like, you got to make sure it's worth it between all the effort, time. It can get expensive if you're trying to go after the bigger one. You have to make your designs. You have to do it before you build the homes and everything. So the tax credits, while were great and they did promote energy efficient things, they were difficult in actual reality. The repealing of this, I don't know if that was the right move, but it's the move that was made by the administration. And so they're trying to say, all right, we're energy efficient homes, I think, are just being built in general now. We're not going to try and promote zero energy energy homes and things like that. We're going to go back to the old ways, which is cost segregations, accelerating your deduction.
Incentivized development. Yeah.
Correct.
Yeah.
Incentivized development. We're not going to talk about it here, but they significantly boosted opportunity zones. So there's other ways they're trying to boost the development and real estate. It's just not through the energy tax credits anymore. If you are using these, you need to know the deadlines are coming up quickly. Most deadlines are going to be June 30th, 2026. That gives everyone, unfortunately, not even a year at this point. And so if you're doing the 45L tax credit, got to make sure the homes are built and sold to or leased to whoever is going to be the actual residence owner who's going to live there. And then if you're doing the 179D deduction, construction needs to start by 6/30/2026. And so a lot of these deductions, they are tax credits and deductions. They take studies. They take a lot of time. So you just need to be making sure if you're taking advantage of these, that you're thinking about it now so that, you can take advantage of in a year. And then unfortunately, once 630 comes and these credits are no longer available, you need to pivot and understand, okay, what can I do? And it's going to be a lot of cost segregations, things like that. You still get the deduction for all the solar panels. You're just not going to get that accelerated tax credit anymore. Still a lot of advantages out there in the real estate space. Still a lot of tax planning that needs to be done. But we're just going to focus a little less on energy tax credits going forward.
Absolutely. Make sure you tell your CPA if you're working on these things so they can help you through the process, and make sure you hit the deadlines. So just to bring us home here, this is really the biggest negative in the one big beautiful bill for our real estate folks. And so as we've kind of demonstrated here, there's a lot of good provisions. This is the main gotcha to look out for here over the next year as these credits start to dry up and we pivot our strategy.
Thank you for tuning in to today's episode. We hope you found our discussion insightful and valuable. If you enjoyed this episode, please subscribe as we produce frequent videos related to rental real estate. Join us next time for more expert insight, tax strategies to help you maximize your real estate investments. Till then, stay informed, stay proactive, and happy investing.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.